Hello everyone and welcome to your Glassnode video report for the 24th of March. Now we've seen Bitcoin rally up to around 44,000 today, and really what we want to look at is what are the fundamental drivers of this rally. And we're actually going to go a step further than that and look at what is driving the current price action, and then try and look at some of the tools that suggest, is it actually a healthy rally? Do we have the longer term fundamentals, or is this simply a flash in the pan that is more likely to be sold into? So we're going to try and look at this from a couple of angles. We're trying to assess what the mechanisms are that's driving the market and whether that trend can be sustained. So we're first going to start with the derivatives markets, and particularly we're going to have a look at the short liquidations and the long liquidation dominance, try and understand whether it's actually shorts that are being squeezed out of their positions. Is that what's creating that rocket fuel to push prices higher? We're going to spend a bit of time with the accumulation trends, both on an address level, but also using the accumulation trend score, which is showing a very, very interesting pattern. And for those of you who watch the accumulation trend score guide, you'll notice that we actually talked about how this current market structure is quite different to 2018 and has a lot more structural similarities to the 2019 market. And then what we're going to close on is some of those much bigger, longer term supply dynamics and trends. And we're even going to close out on a Workbench tutorial where we're going to build our own supply held more than 1 year net position change. So it's kind of one of these metrics. It's a bit of a good opportunity to explore some of those longer term fundamentals, really understanding that big picture supply dynamics as more and more of these coins get pulled into the 1 year old age bracket. It really is showing that long term sustained accumulation that is happening. So just before we get started with the analysis, please do give us a share and a subscribe. It does help the channel. Do let me know if you enjoy this type of content, which is a little bit more immediate, talking about what's going on in the current market structure, and let me know if you have any questions along the way. Let's get started. So the first metric we're going to look at is the futures short liquidation. So this is just looking at the US dollar value of shorts that get squeezed out of their position. Now, remember that a short means that they have sold a position to open it. They've essentially sold that Bitcoin position. And in the instance where the price moves against them and trades higher, they must buy back their position. And in many instances, they end up being liquidated because essentially they weren't able to close out their position in time. So they become a forced buyer. In order to close out their position, they must be a forced buyer. The exchange forces their positions close. Now you can see that we get these spikes around 6 million, some of these are around 8 million, and these ones get up even to around 15 million. And you can see that these short liquidations typically happen when we have very violent upswings. Essentially, people get very comfortable with a market trend. They see it going down and down and down. In many instances, people are getting long, they get squeezed out, they get long, they get squeezed out, they get long. And eventually they finally feel confident enough and go, you know what, I'm tired of being squeezed out of my long position. I'm going to go short. And impressively, they manage to do that at the exact bottom, and they then get squeezed out in the opposite direction and the trend starts to change. So we can see that short squeezes can create these very, very sharp and very high maneuvers in price. We get these large multi-$1,000 moves in the Bitcoin price, and many millions of dollars get liquidated. Now, if we look at our current market structure, we can see that there's been 1, 2, 3 kind of spikes in this particular metric, but really they're getting up to around 5 million, 2 million, 2 million, and this is on hourly resolution. So we're really zoomed in quite deep here. And what you can see is that, yes, there's some shorts being squeezed, but it doesn't really look like a large sustain. You can see here down at the actual bottom that we've got in place at the moment, that $33,000 bottom, you can see a lot of shorts were squeezed, and they were betting the whole way up that it was going to keep going lower, and they kept getting squeezed. This really feels like a short squeeze. What we see at the moment is positive price action, but it doesn't really have the amount of short squeeze that you would expect given the amount that it's actually moving higher. So it's part of the equation, but it certainly doesn't feel like the primary part of the equation. So now we're going to look to our futures long liquidation dominance. So that was the shorts that were being squeezed. There's also longs who are in that market. So there's two sides to all of this. And what this metric does is it will trade at a value of 50% when you've got an equal number of longs and shorts being squeezed. Because this happens on a regular basis, people are always betting in different directions with leverage. And what this is trying to show is which side is getting squeezed more heavily on any particular time. So let's actually just take a step through what we've seen over the last year and try and map this out. So what we can see is that through most of the 2021, the bull phase, all the way through to the July lows, note that we traded above 50%. We're in the red zone. Now, what that indicates is that most of the people who are getting squeezed out of their positions and liquidated were on the long side. There were people who were betting it to go higher. And interestingly, this is a short squeeze. See how we get this large dip on the July rally, large price appreciation alongside it transitioning down below 50% and down to around 40%. So this is showing that the vast majority of people who were getting liquidated at that point in time were on the short side. And note that they were short the entire way through this rally. Really, it was only when we got up to the all-time high in October that the market actually swapped back over to longs being liquidated. So isn't it interesting how people tend to be betting with leverage in the exact wrong direction of the trend? This is why we get this overall long liquidation dominance typically moves counter trend. When we're seeing a downtrend, people are trying to long the bottom and they get wiped out. They long the next bottom, they get wiped out until we get down to a relative low. And this is after a multi-month downtrend. We've spent two and a half months in this consolidation. And interestingly, this is the time after all of this downside. This is when people decide it's a good time to go short. Isn't it interesting? They're doing it at the exact wrong time. So you can see here that we've transitioned back into short liquidation dominance. So it's showing again, like that previous metric, we do have shorts being squeezed. It is part of the reason why we're moving higher, but it's also not the most significant. $2 million at the end of the day is not a huge amount on an hourly candle, especially relative to what we've seen in the past. So it's part of it, but it's really not the entire picture. So let's dig a little bit deeper. So this is zooming out a little bit more and getting onto some of the on-chain techniques. Now, this is actually one of my personal favorite metrics. This is liveliness. Now, what liveliness does, it's a very, very big picture metric, and it looks at the total amount of coin day destruction. Remember, the longer that a coin is dormant, the more coin time it's accumulating. When that coin is spent, it destroys that coin time. So when we get lots of old coins being spent, like during a bull market where old hands are cashing out into strength, we see these large uptrends in liveliness. It's showing that lots of coin days are being destroyed relative to the amount that are being created. Now, conversely, during bearish trends, we typically see a transition where hodlers enter the market, they start accumulating coins, come out of exchanges, go into cold storage, and they start accumulating coin time rather than destroying it. So large downtrends in liveliness is a bullish signal, but as you can see through 2019 and 2020, it takes a long time to play out. It's a very slow moving metric, but it's trying to paint a bit of a picture. What is the macro environment looking like? And you can see that really since our May sell-off back here in 2021, we've been in a downtrend. And given that we're getting towards the back end of March, that's almost 12 months worth of downtrend in liveliness. It's a non-trivial amount. It's showing that hodling is the dominant behavior that's going on in the space right now. Now we get the occasional uptick here, but really the macro trend is to the downside. So what this is painting is a constructive forward look. It's showing that we do have a hodler-dominated market. Even though price may not reflect it immediately, it does take time. We can kind of walk away from this with a backdrop saying this actually looks reasonably healthy. So it's good for the medium to long term. So now let's step into the next metric. So now let's look a little bit more immediate. We know that we've got a reasonably strong backdrop. We know that there's some shorts that are being squeezed, but in terms of on-chain metrics, do we have immediate demand? Is there people actually buying right now? And, you know, this is one of my favorite metrics as well, the number of addresses with non-zero balance, quite simply because it is so simple, right? This is one of these metrics that's just showing, do we have more people pulling coins out of exchanges, putting them into wallets? Overall, what we want to see is a strong uptrend in this metric. And we can see that really since 2018, it's been in a very strong uptrend. We saw the bull market get reflected in an acceleration. This metric really powered up through that all the way into the peak. Then we saw a bit of a flat line. And you can see that this plateaued through most of 2021. And it was really only in October, yet again at the all-time high, where the market really started to step in. Now, what we can see is that over the last couple of weeks, notice how we've actually seen a bit of an acceleration. It's starting to really curl to the upside. So we are seeing that people, even though we're at depressed prices, and even though we've been in what I would call a bear market since May 2021, almost a year-long bear now, and by the way, we all-time high in a bear market, which if you haven't seen that before, that's certainly a unique part of this particular market. But what we're seeing is that despite all of that, all of the geopolitical uncertainties, the macro headwinds, the Fed hiking rates, all of the risks in the economy that we have right now, people are still accumulating BTC, and there are more non-zero addresses in the network than not. And it's kind of showing that that strength does exist. So now we're going to take it that next step over. This is a tier 3 metric, and this is the number of accumulation addresses. So of those non-zero addresses, how many of them are basically just buying and adding, buying and adding, buying and adding? So it's showing that high conviction accumulation. And what we can see is a very similar trend. We had the 2017 blow off top, which really flushed out a lot of users, a large long plateau through 2018. As we collapsed down to these very depressed prices in November and December 2018, notice that we started to get a strong uptrend. We're seeing the number of accumulation addresses essentially on the ascent. 2019 and 2020, even though they were a bear market, there was lots of accumulation that happened here. And really, there's a saying that goes, bear markets author the bull. And what we see here is that during that bear market, the amount of accumulation that was going on eventually authored the bull market that followed. You can see that some of those accumulation addresses started to liquidate their holdings, and they really started stacking again all the way through this bear. And over recent weeks, note how much this has ticked higher. Very, very significant uptick in overall accumulation balance. So it's showing that we do have more and more people in the immediate term who are stacking. So again, it's painting that picture that we've got short squeeze on one side, but it also appears that there's a true organic demand that we can see through address growth. And let's take everything that we just captured and bake it down into the accumulation trend score. So this is one of the metrics we released more recently. And this really tries to bring a lot of information and bring it all together into a single metric that trades between 0 and 1. Now, just as a quick hint, I'm actually going to stick a 7-day moving average on this because I find that it just makes it that little bit easier to visualize. Now, to just describe how this works, and I would certainly direct you to our video guide on this particular metric where we explore it all the way through Bitcoin's history. You can see how it works. But generally speaking, when we've got a value closer to 1, these very white hot colors, it's showing that there's a large amount of whales and or a large portion of the market that is adding significantly to their balance. We're seeing genuine accumulation on chain. Now, conversely, when we have a darker color, these browner and oranger colors, which we saw at the top here and pretty much all the way through 2021, that is signaling more distribution. People are not adding to their balance, and in many instances, they're actually flushing out their balance. So what we're seeing is this kind of change in character over time. Now, what I want to highlight here is that we obviously saw a lot of strength in the early phase of the bull, which cooled off essentially through February and May. And then we entered our bear market up until roughly October. And much the same way that we saw all of our address metrics start to curl up, and at that point in time, note that we started to move back into this white hot zone through this first part of the correction. So it's showing that there was a lot of accumulation that actually happened during the first phase of this downturn. And note that even as we oscillated up and down, this is not quite as white hot. But note that as we get towards the end here, we're starting to get to 0.5, 0.6. It's been quite hot during the recent weeks. So it's showing that during these kind of depressed prices, we're seeing a lot more accumulation going on. It certainly doesn't look anything like what we had at the top here. It doesn't really look like what we had back here where we had this multi-month long downtrend. You can see here we have an upside price potential and we're seeing accumulation at the same time. And it really backs up those previous metrics that we saw. And just to really highlight just how significant this accumulation has been, this is the URPD. This is like a volume profile that you may have seen in technical analysis, but it's focused specifically on on-chain transactions. So what we're looking at here is between 35,000 and 44,000. Look how much supply has been reaccumulated. People who bought the top up here have sold their coins. Somebody else has stepped in and bought them. And we now have a very, very large cost basis that has been developed down here in this zone, in this 35,000 all the way to 45,000. It shows that investors saw value down here. It shows that a lot of wealth was transferred to this point. And overall, it paints a fairly constructive support signal. And you can see that we're now trading towards the top end of that range. And if you think about it, people who bought their coins at the top have now sold lower. That sell pressure has essentially already been redistributed. It takes away a lot of that resistance for price on the way up. Now, it doesn't mean that we're not going to hit some kind of headwinds, but it does show that at least a large portion of the market sees that there is value down in this $30,000 to $40,000 realm. It looks much the same as what we saw back in July, where we saw a huge amount of supply that was redistributed down to that $30,000 level, and that created somewhat of a springboard. So overall, the fundamentals look quite healthy. And then for our last metric before we get into the Workbench tutorial, this is our long-term holder market inflation rate. We introduced this in one of our week on chains about 2 weeks ago. And what this is really looking at is how much, if we think about the amount of issuance that we're having into the system, Bitcoin has somewhere around 1.8% in terms of issuance rate. So these are coins that are coming in and diluting the current holders. Now, we also have market forces such as long-term holders who, we can see these negative values here, are essentially selling into market strength. At the end of a bull market, they are selling at the maximum level, and we actually have the amount of issuance plus long-term holder sell side. So rather than it being 1.8%, it's closer to 13%. So you can show that the long-term holders are adding sell side pressure. It's like almost consider it a market inflation rate. It's like an additional inflation rate as a result of sell side pressure. Now, conversely, when we have long-term holders who are buying and holding, note that at the very bottom, you may be able to see our bear market in the background here. At the absolute lows, we have very, very high market inflation rates. This is 22%. It's actually showing that long-term holders are stacking sats and pulling 22% of the circulating supply out of the market over the course of the last year. So these positive inflation rates is showing that we have accumulation going over and above issuance. They're buying all of the issuance, and then they're also buying coins off the market. So it shows that strong accumulation potential. And here we are sitting at around 14, 15%. So right now, long-term holder supply is growing at a rate of 15% of circulating every single year, which is a non-trivial amount. It is significant. It's more than what we had here at the start of the 2020 bull. It's not quite as much as what we had back here at the end of the 2018 bear, but it is certainly a very, very constructive number that shows that we do have that accumulation going on in the long term. So before we jump into the Workbench, let's just summarize where we're at. We do have some short squeezes happening. It may continue. We do have a relatively strong hodling characteristic, as we saw with the liveliness, with our addresses, and our accumulation balances. And then our accumulation score really painted a picture of fairly recent accumulation, and it shows that overall there's fairly strong supply dynamics that are going on in the background. Overall, it paints a good picture. We're not out of the woods yet. We're still a long way below all-time high. But in terms of setting the stage for positive price appreciation, at the moment, it looks relatively constructive. So just to close out this session, I want to show you how you can build up using Workbench a very simple oscillator similar to what we just looked at with the market inflation rate, but a little bit simpler. What we're going to look at is our supply older than 1 year. So the first thing I'm going to do is add a metric. I'm going to do a 1+. This is going to be our supply last active 1 year ago. We're going to make this one orange, and we're going to leave it onto the Y2 axis. Now, remember that this one here is a percentage. So we're looking at what percent of the supply is in the 1 year old bands and higher. And you can see, similar to long-term holder supply, it will dip at the tops. This is long-term holder distribution. We're seeing those older coins come back to life, putting in the top, putting in the bear market, and then they return to accumulation as the market wears on. Now let's zoom into the next 5 years just to make this a little bit clearer. And I'm going to add a formula bar. Now what we're going to do is we're going to keep our green color, keep this on our Y3 axis. I'm going to turn this to a bar style chart. This is going to be our net position change. So the first thing I'm going to do is do what's called a difference. So if we look at this point here, I want to see what was the difference between it and 30 days ago. How much has this particular metric changed over the last 30 days? So I'm going to say diff, D-I-F-F, and I'm going to go to M2, which is our supply last active, M2, comma, 30 days. And we're going to say evaluate and draw. So now we can see that we have an oscillator, and it's showing that when the supply last active 1 year is on the ascent, we're seeing that this metric will start to climb. It's showing that at this point in time, 4% per month is moving into 1 year old supply. And likewise, at the top here in January, we can see that we have a negative number of negative 3%. That means that negative 3% or 3% of the circulating supply is being sold by these one-year-old coins every single month. So that's what this oscillator is showing. Now, just to really smooth this out, I'm also then going to wrap this function. So we've got our difference, M2 and 30. I'm going to add a second formula, and I'm going to call this SMA. So this is our simple moving average. This one here is Formula 1, F1, and I'm going to do again 30. So what I'm doing here is taking the 30-day moving average. Let's put this in blue. I will put this again on the Y3 axis, evaluate and draw. And what you can see, let's put this onto a bar chart and I will turn off Formula 1. You can see here, this is now a slightly cleaner metric. We've just taken out that 30-day noise. So it's taken this F1 is that diff function, diff1 of M2 at a 30-day period. And what we're doing is just smoothing that by 30 days. And you can see it just makes it that little bit cleaner. So the way to interpret this signal is that negative values are showing that these one-year-old coins are distributing. They're spending their coins. It is increasing the chance that we're going to get some kind of sell side. And likewise, when we have these positive values, it's showing that we have a lot of growth. There's huge amounts of coins moving into that one-year-old supply, and they're otherwise not going to be available for sale. So it's kind of showing that overall accumulation trend. And you can see that right now, we're at a non-trivial level. We're at, up here at 2.4%. So 2.4% of the supply moves into 1 year old every single month. And you can see this is actually not dissimilar to the late stage of the 2018 bear. And it's actually much higher than what we had here post March 2020. So it is a non-trivial amount. Remember that this is a slightly lagging indicator because 1 year supply takes 1 year to become 1 year old, but it is showing that we have a big trend of overall long-term supply dynamics that are relatively constructive. So hopefully that's useful. Do let me know in the comments if you want to see more of these kind of workbench tutorials, and we can certainly run through more in the future. So thanks for tuning in, everyone. Please do give us a share and a subscribe. It does help people get to this channel. I would recommend spending some time with the Accumulation Trend Score. You will find a very detailed explanation in the Glassnode Academy, and you can also see our video guide on this metric. And really, this is painting kind of the picture of, even though there's uncertainty in the market right now, during this 2-month-long consolidation, there has been a fairly strong amount of accumulation that has gone on. So if we think about what's driving this space, there's part of it is short squeezes, but to be honest, a lot of it looks like just natural demand for actual spot BTC that appears to have accumulated between that $35,000 and that $45,000 level. So overall, fairly constructive, and let's see how we progress over the coming weeks. I'll catch you on Monday. Cheers.